Hello, I'm Kirsten Aiken. Welcome to the Business Summer Special. We'll be taking the pulse of the nation's economy.
It has been government spending that has kept GDP growth in the positive.
And getting a steer on when or if the Reserve Bank will cut rates.
There's at least some chance that the RBA may not get to cut interest rates in 2025 at all.
Also on the program, a tough year for business. We take a look at the hardest hit industries. Higher for longer interest rates have placed the economy under growing strain. Quarterly GDP data released in December showed growth has slowed to levels not seen since the 1990s recession. If not for government spending and migration, the economy would be in recession. Rihanna Whitson reports.
The economy is flatlining. At a household level, Australians have been going backwards for almost 2 years, which hasn't shocked those struggling to keep up.
Groceries. That's very expensive with 4 boys, yeah.
We're shopping for needs, not for wants at the moment. My husband has a great job, but still stressful. And we're doing it as a family unit now. We're all understanding the value of money, and what we need is what we buy.
Australia's economy grew below expectations at 0.3% in the 3 months to September and 0.8% for the year. That's the weakest annual growth since the 90s recession, outside of the pandemic. It was held up by government spending on energy rebates and investment in infrastructure and defence equipment. Household spending was flat as Australians banked the Stage 3 tax cuts.
Growth is weak. And we know why that's the case. It is weighed down very substantially by the interest rate rises which began before the election, combined with those cost of living pressures weighing on household budgets and the global economic uncertainty.
GDP per capita going backwards for the 7th consecutive quarter. We have now been in a household recession for 7 quarters. It was a record after 6 quarters. It's still a record.
But economists say it could be worse.
We can see for the last 2 quarters, really, it has been government spending that has kept GDP growth in the positive. And so without that, and if you took that away, the Australian economy would now be, facing a recessionary conditions.
The growth in household savings is an indicator that Australians feel under financial pressure and are worried about the future. These numbers will come as a surprise to the Reserve Bank, which economists say will come under more pressure to cut interest rates.
The sooner that is done, the sooner that pressure is taken off households and the economy will start to recover. What this means in terms of what the market's now forecasting, I think, is we'll see more economists coming out and predicting an earlier rate cut, potentially in February next year, as the Reserve Bank looks for that economic recovery and looks to support economic growth through 2025.
After enduring hard times, the building industry showed signs of recovery in the September quarter.
There's obviously a lot of work in the pipeline, probably due to the push from the government to densify housing and to build more housing. But at the same time, I'm also seeing that the approvals are taking longer and that there is a more regulated and more stringent approval process.
High material prices and worker shortages persist, but pressures are easing.
We have 4 or 5 tenders closing, so I'm hoping a few of them will drop and there will be a February or March start. So overall, I think the outlook is bright.
Building hope in a sluggish economy.
The Reserve Bank didn't consider a rate cut as it met for the final time in 2024. Before the board took summer leave, it left borrowers with a cash rate at a 13-year high for the 13th straight month. But it did signal a change in tone, saying it's gaining some confidence inflationary pressures are easing. As David Chow reports, that seems like too little too late for a growing number of borrowers.
Mortgage stress is running high across Australia, particularly in Marsden Park, 50 kilometres northwest of Sydney.
I had 2 mortgages. Can you imagine the pain? So we're looking forward if the government or the RBA making the interest lower, that would be a big help to everyone.
In newly built suburbs like this, more than 6 out of 10 borrowers are still paying off their home loans while struggling with the everyday cost of living.
It's just going higher and higher, and for families and especially with young children, it's a very difficult time.
And there's no rate relief from the Reserve Bank, which has kept the cash rate on hold at 4.35%. But the message has softened.
We did not explicitly consider an interest rate cut, or the reverse, I should add. You just can't plonk a whole lot of...
The RBA governor says the battle against inflation isn't over yet, but the board is confident it's making progress. So what about an early rate cut in 2025?
I honestly don't know if we're going to be cutting in February. We're going to be looking at the data and be data-driven.
If we start to see the unemployment rate creeping higher in the next monthly set of employment figures, then I think it may cement that February rate cut.
The Reserve Bank has been criticised for being too slow to lift interest rates when inflation took off a couple of years ago. Now there's a risk it might be taking too long to bring rates down, especially with the economy growing at its slowest rate in about 3 decades. So do you think there's the risk the RBA might repeat mistakes of the past by moving too slowly?
So if we really thought we had things wrong, we would have moved, David, I think, is the answer to that. We have to have a period of slower growth, but our forecast suggests that growth will start to pick up as real disposable incomes start to pick up over the coming year, and that inflation will continue to come down. So we still think we're on that path.
A narrow path propped up at the moment by migration and government spending.
We understand that people are under substantial pressure and interest rates are part of the story.
It is clear that this economy is sick and a doctor's spin is not going to fix it.
Once the Reserve Bank gets underway, we'll likely see multiple rate reductions.
I think we could probably see between 3 to 4 cuts in 2025.
Even though there's talk of rate cuts in a few months, that's not soon enough for many borrowers.
If it's only talks, then it's getting nowhere. We need to see something, action.
The final unemployment read for the year, showing the jobs market is running hot, took many economists by surprise. The unemployment rate fell to 3.9% in November, its lowest level since March. It was partly due to people leaving the workforce, which pushed the participation rate down, as well as the creation of nearly 36,000 full-time jobs. HSBC Chief Economist Paul Bloxham says the figures could prompt the Reserve Bank to leave rates on hold for another year.
Our view is that they won't get to cut rates until probably the middle of next year at the earliest, and there's at least some chance in our view that the RBA may not get to cut interest rates in 2025 at all. The RBA's got an inflation target. They're trying to get inflation down, and core inflation is still well above where it needs to be. In order to get that inflation to come down, you need to see wages growth slow down. And the way wages growth slows down, of course, is if the labour market continues to loosen. So those are the sort of ways that the RBA thinks about this. This is a signal that the labour market is no longer loosening. It looks as though the unemployment rate may have peaked, and if it has, then that's telling you that wages growth may no longer continue to slow, and it may be hard for them to get inflation in that last mile, back from 3.5 right down to 2.5, which is their target.
It probably isn't the message the Treasurer wanted to deliver right before Christmas, but the mid-year fiscal and economic outlook has revealed successive surpluses are a thing of the past, and the budget is forecast to be in deficit for the next decade. With the federal election expected in the first 5 months of 2025, the economy is set to play a key role in the campaign. And the government will continue to face questions about why it's dramatically increasing spending as the economy struggles.
There will always be people who say cut harder. There will always be people who say cut less. Our job is to take the right budget decisions for the right economic reasons, and I'm confident that we've been doing that.
2024 has been marked by a number of major geopolitical shocks and risks. The war in the Middle East, the continuing conflict in Ukraine, and the election of Donald Trump in the United States, who has vowed to reshape the American economy, boost domestic manufacturing, and impose tariffs on America's trading partners. Nouriel Roubini is an American economist who earned the name Dr. Doom by predicting the global financial crisis. I sat down with him on the sidelines of the World Business Forum in Sydney. Welcome to The Business. How will the US economy be transformed under Trump?
There are some of the policies of Trump that might increase growth and reduce inflation, being pro-business, low tax rates for the corporate sector, deregulation, more production of fossil fuels. But there are other policies that might have the opposite impact, reduce economic growth and increase inflation, tariffs and trade wars, significant restriction to migration, unfunded tax cuts that lead to higher budget deficits, that leads to higher interest rates, crowding growth, budget attempts to try to devalue the value of the dollar, reducing the independence of the Fed and the central bank, and possibly exacerbation of some of the geopolitical conflict, including economic war with China. So we don't know yet on net whether the more positive policy, the increased growth, reduce inflation, are going to be dominant compared to the stagflationary policies that reduce growth and increase inflation. I think there are more questions than answers on that.
On stagflation, how great is that risk under the incoming administration?
Well, if Trump was really serious about 60% tariffs on China, 10 to 20 on all other trading partners, about weakening sharply the dollar, about draconian restrictions on migration and mass deportation, about tax cuts that are not funded by raising other taxes or cutting spending, making the Fed less independent. All those things got to imply higher inflation, higher interest rates, and the crowding out of economic growth. I think it's going to be restrained because if he tries to follow these policies that are stagflationary, interest rates are going to be much higher, bond yield is going to be higher, the Fed will have to raise rates rather than cutting them, the stock market is going to correct. He cares about the bond market, he cares about the stock market, and therefore market discipline as opposed to political discipline. There is no political discipline because it controls the executive, the Supreme Court, the judges, the Congress. So the only discipline can come is bond vigilantes and markets telling him that some of his policies are not going to be sustainable. That's going to be the main constraint to not to follow silly policies.
But you say that sense may prevail and that he may implement changes in a more orderly fashion, creating less volatility.
Yes. First, his choice of the main economic advisors, starting with the Secretary of the Treasury, may be important. Two, if he's aware, because his advisors are telling him that those risky policies are going to be punished with the stock market going down and bond yields going higher, those threats of market discipline may lead him to not follow those policies in the first place.
But do you hold concerns about those appointments that have already been announced? For instance, today we have learned that a television host from Fox and Friends is to become the Secretary of Defence.
Yes, some of those choices seem sensible, like Mark Rubio as Secretary of State is certainly his expertise on foreign policy, even if he's a bit of a hawk on China. But other ones, like the recent choice of the head of the Pentagon, seem to be given to somebody who is not really a military expert. He has military experience, but he doesn't have the seniority to run a huge organization like the Department of Defense. And it's also possible that the Senate may not confirm those appointments that are actually not serious and valuable.
In the event of stagflation, what would that mean for global interest rates and interest rates in an open economy such as Australia's?
Well, if US were to follow policies that increase inflation, reduce economic growth, interest rates will be higher in the United States, both short-term interest rates because the Federal Reserve will have to raise rates rather than cutting them, and bond yields are going to be higher because there's more inflation, and real rates are higher because the deficits are unsustainable. That's dangerous for the rest of the world because high interest rates in the world imply that other countries have to follow the US. If they don't follow the US, their currency weaken. So interest rates globally are going to be higher, and that's going to crowd out growth globally. Of course, tariff in the US cause inflation in the US, but cause economic damage like less demand for the exports of other countries, and that's deflationary and leads to less economic growth for the rest of the world as well.
Do you expect Australians will have to wait longer for interest rate cuts as a result of Trump gaining the keys to the White House once again?
It depends. If we were to impose tariffs that reduce economic growth and inflation in Australia, those tax cuts may be coming sooner. But if instead this policy lead to higher global interest rates, and then those interest rates go higher in Australia, then you'll have further crowding out of economic growth. I would say that most of the challenge of Australia are domestic. Growth is weak, but inflation is sticky, because probably the China shock implies lower growth, but most of the growth now is deriving from demand coming from the public sector, and that's leading to inflation to remain higher than otherwise. So you need to do economic reform that lead to greater productivity in the private sector rather than relying on the public sector in order to have a strong economic growth.
Nouriel Roubini, terrific to have you on the program. Thank you.
Great being with you today. Thanks.
As we heard earlier in the program, businesses have been doing it increasingly tough in 2024, with hospitality the hardest hit. Cafes and restaurants say their margins are being squeezed by rising costs and falling customer numbers as people rein in their spending. A growing number of businesses are being forced to shut their doors. Amelia Turzon reports.
In the coffee capital, running a cafe is a daily hustle.
Good morning.
Good morning. How is business going?
Business is good, but it's tough.
What's tough?
Well, recovering from the pandemic. Wages have risen 2 or 3 times since the pandemic. Super's gone up. Rent's quite high.
Veronica and her husband Francesco get up at 4 a.m. every day to run their small business. Despite data showing that Australia has some of the cheapest lattes in the world at less than $5 a cup, this cafe is struggling to increase prices during a cost of living crisis.
If we raise it 50 cents, it's like a drama, but we struggle to make profit.
What's the margin on a cup of coffee?
The margin is around, the profit's around 20%.
Their milk has been going up in price, and while Veronica says that coffee is stable right now, this economist is now warning about a price hike on beans.
We're seeing more erratic events of weather around the world as a result of climate change, and we're seeing that affect a whole range of commodities. Cocoa prices have been at record highs. We've seen orange juice prices pick up, olive oil prices pick up, and of course coffee.
At this restaurant, cappuccinos aren't even profitable.
But nowadays, coffee is not a moneymaker unless you're a specialty coffee place.
And what else has the margins gone down on?
Everything, really, like let's say oil have gone up 100%.
The newly opened restaurant is also run by a small business couple. They make their money off food and alcohol, and as fine diners also pull back, Azarko is getting worried.
Someday you do so bad that you can't even pay staff.
And so how are you surviving at the moment as a business?
It's hard to say because it's still early days. We just opened up in July. By moving here and with the construction costs and everything, obviously there's lots of debt that we have. You gotta keep dreaming and you gotta see the light at the end of the tunnel, thinking we have to get through this. I mean, we have to because we got so much debt anyway.
Insolvencies have been steadily rising in the hospitality industry in the last few years, coming second only to those in the construction industry.
We know that there are a number of pressure points on the sector at the moment. We know that things are tough on the sector. What I want to assure people is this is not our sector profiteering in any way.
The Industry Association wants more support in the federal budget on things like power bills.
The sooner they bring on some sort of assistance for energy, the sooner our sector will see relief. The other area that we're calling on for assistance is the cost of apprentices and trainees.
Azarko says they're worried if they take cash from the government, they may have to pay it back.
And so what will you do to stay open?
keep pushing, keep working. You gotta love it to be in it, isn't it?
Right now, it is the restaurant industry's motto.
The construction industry is another sector that's gone from bad to worse. With insolvency numbers high, consumers have been increasingly wary of signing on to new contracts, exacerbating an already dire housing crisis. Nasim Kadem.
IT worker Patrick Quintal deeply regrets buying into apartments in Sydney's West. He says people shouldn't buy off the plan or into newly built apartments.
Just don't do it. You are playing Russian roulette with your life, basically, is what's happening. In fact, I think you might actually have better odds playing Russian roulette than this.
Patrick's apartment was built by Top Place, once one of Australia's largest privately owned development companies. The developer went into administration in July 2023, and its founder, Jean Nassif, who's believed to be overseas and wanted by police on fraud charges, left behind dozens of developments with defects. Mr. Quintal is now one of hundreds of owners that are expected to pay upwards of $180,000 each to fix serious defects. He worries the building, which is being held up by a temporary structure, could collapse.
The building as it stands could not support any kind of movement that was similar to a seismic activity, right?
Further out of Sydney, Alyssa is another disappointed consumer. She's taking legal action against another builder that she says didn't finish the job properly. She's finding traces of what might be toxic silica dust throughout her home.
Mentally, I try to be strong for myself, for the family and for my baby, but I feel that, my baby shouldn't deserve this.
The consumer pain is holding back people from building. The latest building approvals data for February shows another steep decline and confirms Australia's record level of immigration is outpacing new construction. Perth developer and industry veteran Nigel Satterley is calling for changes that would require builders to put consumer deposits into a trust account.
We need a lot more corporate regulation around directors that trade, the building companies that know they can't pay the bills or they're insolvent.
Figures from corporate watchdog ASIC show that in the year to March 17, there's been almost 2,000 building and construction company insolvencies. That's well above the rate seen in the year before. And when builders go under, it's not just customers that are left in the lurch. Often subcontractors and suppliers also miss out on getting paid.
I think there should be serious regulation that if they're not paid, they should be able to lodge an immediate complaint for protection.
The soaring cost of building is another problem the sector faces.
There's such a pent-up demand. People don't want to take that step because there is that lack of confidence, and I think it comes from two places. One, lack of confidence about their affordability, and also lack of confidence in building.
I love the space that you get through the rear here, especially with the ceiling height.
That's forcing builders to cut costs. It was almost 1 year ago when Simmons Homes had to make the tough decision to cut 10% of its workforce.
Let's not deny it, it's been a tough period for the industry for the last probably 2 to 3 years.
For all those 3 years, Patrick Quintal has been fighting to have authorities take responsibility for the mess created. He says the onus shouldn't be on consumers to fix problems with dodgy builders.
And they've just kind of, left us to hang dry.
Like Patrick, for many, there'll be no easy fix.
2024 has been a strong year for the Australian share market. But what can we expect in 2025? I spoke to Wavestone Capital Portfolio Manager Catherine Orfrey. Hi, Catherine.
Hi.
The ASX 200 punched successive record highs in 24, and despite the macroeconomic picture, results season saw many companies performing above expectations. Which were the standout sectors for you?
The tech sector clearly was like 50% for the year, and then clearly the financials after that were very strong. Conversely, I guess on the negative side, the resources struggled all through the year, predominantly because of the China data was pretty weak all year.
Where do you think the market is going to go? Do you think we're going to be seeing successive new highs?
The fact is that earnings growth has been pretty lame here in Australia versus the US. So what we would like to see is obviously some earnings growth come through in 2025 for Australian corporates, but also valuation at the moment is actually quite high. It's quite punchy, just over 18 times, price to earnings ratio, and versus historically that's about 16. So we really do need that earnings growth to come through in 25 to support the market. But generally out of equities, you can expect 8 or 9%, and while there's rate cuts on offer, that's still very, positive for markets overall.
When we're talking about valuations, often the banking sector comes to mind. What do you see ahead for banks next year? Can they sustain these current valuations?
That's the million-dollar question, isn't it? They haven't done it in terms of earning growth. They've actually done it in terms of a revaluation, in terms of their price to earnings multiple that they trade on. But also they have offered to investors, capital returns. They've had really strong dividends. They've also had buybacks on offer. And in cases of Westpac, they've even thrown in a special dividend. So it's actually been quite positive for investors, the overall outcome for banks. Now, the question is, CBA is obviously one of the most expensive banks in the world. So Australians' banking sector has done extremely well. I think it will be a tougher year for them in 25.
Okay, and the companies and sectors that you are closely watching next year?
You always watch the tech sector because that's where the change is happening. We want to see the consumer in terms of consumer discretionary, but we look for companies that are quality and we want compounders over time. So a lot of the companies that we back, Goodman, Car Group, they've performed very well over a long period of time. Some companies that have really lagged that are in our portfolio that we would be hoping in 25 we will see some positive share price reaction to would be calling out Santos because finally they're going to get some production at the back end of next year, and then also CSL. That's been a real laggard. So let's see what 25 is in store.
Catherine Allfrey, thank you.
You're most welcome.
Thanks for watching the Business Summer Special. Our specialist business reporters will continue to bring you the latest news on digital and social platforms, as well as on ABC News throughout the summer break. The Business will return in late January, Monday to Thursday at 8:45 p.m. on the ABC News channel and after the late news on ABC TV. But you can watch us anytime on ABC iView. I'm Kirsten Aiken. See you soon.